Hello, I'm Chris Sarley, Investment Research Analyst at FundCalibre, and today I'm delighted to be joined by Vincent Ropers, Manager of the elite-rated Wise Multi-Asset Growth Fund. Thank you for joining us today, Vincent.
It's a pleasure.
Could I start by talking about Asia? You've been gradually sort of increasing your exposure to emerging markets, and particularly Asia recently. Is this based purely on lockdown easing in the East, or is it more of a long-term play in your view?
No, it's very much a long-term play. We actually started increasing our exposure to emerging markets and Asia in particular, probably about 2.5 years ago. And that was on the back of we were in a situation where global growth was getting scarce, and at a time when emerging markets were very much under-owned by the investment community. So we looked at emerging markets as one of the few places where we could still get very attractive growth. And because the asset class was under-owned, valuations were also very attractive. So over the past 2.5 years, we've been building up our position through dedicated Asian managers and emerging market managers. And we actually increased our allocation at the end of last year and the start of this year, because we shifted our view from towards a more pro-cyclical stance. We could see that generally industrial production and growth was picking up at the end of last year. And there were also some of the big concerns that had been hanging over equity prices in those regions for the whole of 2019 that were lifted, namely the trade tensions between US and China. So on the back of that, we increased our allocation. But in relative terms, we can see, particularly in Asia, how much better the pandemic has been dealt with in Asia compared to the West, at least so far. And we are in a situation when, in relative terms, we still expect emerging markets to grow much more quickly than developed ones. And from a valuation standpoint, the investment case is even more compelling now.
I wanted to talk about, obviously, the last few months have been very tumultuous for everyone really in the markets and in life in general. We've seen a lot of managers talking that we've spoken to in terms of the sell-off and highlighting the opportunities that have been available to them at attractive prices. I mean, you touched on it there. You said in your annual report that you felt that now was not the time to make heroic changes, and that the lack of liquidity makes it impossible to trust prices in any case. I mean, things have perhaps settled down or perhaps not since April. I mean, what's your view now? Is it still the same, or has it changed? Maybe just talk us through your opinion on that now.
No, you're right. I definitely think that things have stabilized. We're in a more normalized environment, if not normal environment. We're certainly not back to normal times in terms of liquidity and price action. There's no doubt about that. But the astonishing price moves that we saw in February, March are now behind us. But what I meant in the investment report is that when you've got situations like those where prices move so quickly, actually the price that you see on your screen is a price that can't be trusted, because what we observe is that liquidity dries out completely and only a few thousand shares move the price in one direction or another. And when we were talking to our brokers, it was obvious in the midst of the sell-off in February and into March, there was clearly no institutional trading in a lot of in the investment trust that we're looking at. So those prices were moved almost purely by a few retail orders, which meant that even if something looked particularly attractive from a price standpoint, it wouldn't have been something that we would have been able to take advantage of. Another point that I would make is that we were in the fortunate position going into February, March of not feeling that we had to trade, because the way we had positioned the portfolio, we had about 20% of the funds allocated to what I would call all-weather strategy, which is a mixture of absolute return defensive strategies, but also more, strategies like gold, for example. So those have helped us during the sell-off, which meant that we didn't feel that we had to change the shape of the portfolio. Another very strong factor is that we spent a lot of time focusing qualitatively on assessing our managers. And in a way, if we have done our job properly, we shouldn't have bad surprises in a period of volatility like we experienced.
Just lastly, I wanted to finish on a couple of the alternative positions you have. You talked about gold earlier, but also infrastructure. Could you maybe just give us a quick line on both of them in terms of your outlook and your positions you hold with them and why?
Sure. Well, gold is a very interesting asset class. We've had a large allocation to gold equities for a couple of years now. Last year, the argument was really, as interest rates kept coming down, the investment case for gold is strengthening because it is an asset that doesn't yield anything, so hasn't got any income. So in comparison with other asset classes that are yielding something, if the yield on those is coming down, comparatively, gold is becoming more attractive. And that's the crux of the reason behind the strong rally of gold last year. And in our mind, we felt that argument still held at the start of the year. But also, we wanted to keep our position because it is a natural hedge against increased volatility, which we thought was likely to arrive, if not to the extent that we saw in the first quarter. So all those arguments in our mind are still valid, but really the most compelling argument is for gold equities in our mind at the moment, because those companies have the strongest balance sheets that they've had in the past 2 decades. They've spent the past few years really cutting their costs, making sure they are much leaner, and are in a position of strength, which they are in at the moment. And their profitability is going through the roof, not only because the price of gold has increased dramatically over the past few months, but also because their costs have come down dramatically. The main cost for gold producers is oil, and oil has gone from $65 at the start of the year to $35 at the moment. So that is a significant reduction in cost. And those companies are still very much under-owned by global investors. So we think there is a lot of upside there. And there is also a lot of upside in silver, which tends to behave with a lag with gold, but when it catches up with gold, it tends to do it on steroids, so it tends to catch up very quickly. So we think there is an opportunity there as well, and our managers are investing in both gold and silver. And another point for silver is that it is used in a lot of the mega trends that we're seeing at the moment that are likely to last in the use of renewable energy, electric vehicles, even the use of 5G. All those technologies are using a lot of silver, which should support the metal. So we invest in both. And in terms of infrastructure, it is an asset class that we like a lot. It is very diverse. It is so it goes from your utilities to transport to telecommunications, so very, very broad, and is somewhat in the sweet spot where it offers defensive characteristics. So that's the utility side of the argument for a lot of those companies, as well as growth opportunities, mainly through the exposure to the growth in renewable energy. So we really like the asset class. It also offers an inflation hedge, and we don't have a very strong view whether inflation is going to come or not, but it seems to us likely that with the tremendous growth in debt that we've seen globally over the past few weeks, inflation is likely to make a comeback. So that's another element of the argument. And the final element is that it seems clear to us that we are migrating from monetary stimulus to fiscal stimulus and on a global basis. And this fiscal stimulus is going to benefit all the infrastructure, the big infrastructure projects.
That's great, Vincent. Thank you for spending time with us today.
It's been a pleasure. Thank you.
For more information on the WISE Multi-Asset Growth Fund, please visit FundCalibre.com.